The American housing market isn't cooling off. It's quietly collapsing under the weight of its own contradictions. People see for sale signs and rising prices and assume the system is stable. But behind the surface, the foundation is already splitting. Mortgage debt has surged past $12.7 trillion. Affordability has fallen to levels not seen since 1986. A household earning $78,000 a year can now afford less than 18% of homes across the country. For years, homeowners believed rising home valuations represented real wealth and long-term security. In reality, inflation devoured those gains. What many viewed as equity was simply leverage, amplified by cheap credit and disguised as prosperity. That illusion is now crumbling. The first fracture came from interest rates. In 2021, 30-year mortgage rates sat near 2.6%. Today, they hover around 7.8%. A $400,000 mortgage that once cost around $1,600 a month now drains nearly $2,000. That isn't just inflation, it's financial paralysis. Higher rates don't simply cool demand, they eliminate it. Each percentage point increase wipes out roughly 5 million qualified buyers. Millions are priced out before they even apply, while sellers cling to unrealistic values no buyer can finance. The market is frozen because the math no longer works for either side. But interest rates are only part of the breakdown. Wages have barely moved. The median household income crept from $70,800 to around $78,000, about a 10% gain. During that same period, the median home price jumped from $329,000 to over $420,000. The gap between income growth and home prices has widened into a chasm. Today, the average worker must spend roughly 45% of their gross income just to service a mortgage. It's the highest burden on record. Once debt-to-income ratios hit that territory, credit quality deteriorates. Banks start tightening standards. Fewer applications get approved. Lower approvals reduce sales. Lower sales slow the broader economy. The cycle feeds itself. This isn't a normal housing market any longer. It's a machine built on leverage, now eating itself alive. For nearly 2 decades, cheap money created artificial demand, pushing home prices far beyond what real wages could support. With rates rising, the system is unwinding in a slow, grinding reversal. Every new rate hike accelerates the contraction. Signs of the unraveling are everywhere. Pending home sales have fallen 16% in just 1 year. Mortgage applications are sitting at a 28-year low. Builder confidence has plunged into crisis territory. Even once booming Sunbelt markets like Florida, Texas, and Arizona are seeing inventories rise at speeds reminiscent of the 2008 correction. Prices won't come down fast enough to meet wages, and wages won't rise fast enough to meet prices. The middle class is trapped in a narrowing corridor between rising borrowing costs and stagnant paychecks. This isn't a correction. It's a structural failure. But the deepest cracks aren't showing up in suburban neighborhoods. They're forming inside the balance sheets of the institutions that inflated the bubble in the first place. Wall Street turned single-family homes into corporate assets and bought them using layers of debt, credit lines, synthetic bonds, and rent-backed securities. By 2025, institutional investors controlled nearly 1 out of every 5 single-family homes in America. When interest rates jumped, the financing behind these portfolios collapsed. But instead of stopping, many shifted debt into private credit funds, hiding leverage in less regulated corners of the financial system. Now, as yields rise and bond values fall, the chain reaction has begun. Margin calls, forced liquidations, and quiet panic selling. Unlike 2008, this isn't a frenzy on the retail side. It's happening at the institutional level, behind closed doors. Real estate trusts and hedge funds are dumping homes at 15 to 25% discounts, not to give buyers relief, but to survive. And as corporations offload inventory, small landlords and regular homeowners see their equity evaporate. The institutions exiting the market aren't just responding to risk, they're accelerating it. The data confirms what headlines won't say. New home sales are down 14% year over year. Existing home sales continue to slip. Active listings have surged 29%. Homes that once sold within 72 hours now sit unsold for an average of 53 days. Mortgage originations have sunk 55% from their 2021 peak, the sharpest collapse on record. Behind each stagnant listing is a frozen commission, a stalled renovation, a cancelled closing, a lost paycheck. Real estate pros, brokers, inspectors, appraisers, lenders are watching workloads vanish. The market isn't cooling, it's paralyzed. And paralysis kills liquidity. When liquidity dries up, everything slows. Construction, lending, consumer spending, and eventually hiring. This is how recessions begin. The stress is spreading to households. For the first time in modern history, Americans are defaulting on mortgages faster than on auto loans. Early-stage delinquencies have jumped 28% in a single year. The average mortgage balance has hit an all-time high of $206,700. Total household debt now stands above $18.6 trillion, more than the entire U.S. economy. Energy bills are up, insurance premiums are up, property taxes are up, housing-related expenses now consume more than 40% of the average family's net income. Savings have been depleted. Credit card debt has surged to $1.33 trillion. Millions of families are using revolving debt to pay for essentials and, in some cases, to cover mortgage payments themselves. This is not resilience. It's a solvency crisis disguised as survival. As more families reach their breaking point, foreclosures will rise. Those defaults will hit markets already suffering from too much supply and too little demand. Each new foreclosure sale pushes prices lower, deepening losses for homeowners and investors alike. This is the same feedback loop that detonated 2008, only now the system has less savings, more debt, and fewer cushions. Housing doesn't fail in isolation. It drags the entire economy with it. Residential construction spending is down 12% year over year, the steepest drop since the pandemic. Furniture orders have fallen 24%. Appliance sales are down 17%. Home improvement stores are posting their first contractions in a decade. Construction job growth has fallen by more than half. Subcontractors are reporting cancellations at levels not seen since the Great Recession. Thousands of companies tied to real estate, movers, designers, material suppliers, freight carriers are shrinking or shutting down. Housing fuels up to 18% of US GDP. If current trends hold, the drag could knock 1.7% off growth by early 2026, enough to tip the economy into recession even without a financial panic. Meanwhile, the public narrative is still built on denial. Media outlets talk about soft landings and cool downs, even as the data screams otherwise. Sellers cling to fantasy valuations. Buyers hope for rate cuts. Analysts talk about temporary slowdowns. But the truth is straightforward. Confidence is collapsing. Only 14% of Americans believe it's a good time to buy a home, the lowest reading ever recorded. That's not caution, it's surrender. The psychology that built the bubble is now reversing. Belief is evaporating. Then there's the Federal Reserve, trapped in the consequences of its own policies. Between 2020 and 2022, the Fed pumped more than $6 trillion into the economy, driving interest rates to zero and igniting the biggest asset bubble in modern history. Then, when inflation surged to 9.1%, it reversed course and launched the fastest rate hike cycle in 4 decades. The results are contradictory: high rates without relief, low supply without mobility, inflation without growth. The Fed's solution has broken the system's ability to function. Liquidity has drained across all real estate-connected sectors. M2 money supply has shrunk by more than $1 trillion, a deflationary shock not seen since the Great Depression. Regional banks loaded with property loans are tightening credit to survival levels. The credit impulse, the economy's true engine, has flatlined. The Fed can't cut without reigniting inflation. It can't hold without increasing defaults. There is no winning path, only decisions about the speed and form of the decline. The elites have already reacted. Hedge funds, private equity firms, and Wall Street landlords are quietly unloading properties. Institutional property sales have surged more than 60%. Large bulk purchases have fallen to their lowest level since 2012. REITs are selling rental portfolios at steep discounts just to refinance maturing debt. Repo markets are tightening as banks demand higher quality collateral. Capital is fleeing real estate. And when the smartest players exit first, it isn't speculation, it's confirmation. The next stage of the collapse is already forming. It won't look like a sudden explosion. It will feel like exhaustion, slow, grinding, relentless. National home values are already down in nearly 1/3 of metro areas. Some overheated regions may see 35 to 70% declines as investor-owned subdivisions hit the market simultaneously. Foreclosure filings are up 28% year over year. Real estate ETFs are trading at large discounts, signaling that institutional expectations are far worse than official forecasts. Consumer sentiment has broken. Liquidity is draining. Credit is tightening. And trust, the invisible glue that holds markets together, is fading. The reset isn't theoretical. It's underway. The American housing system was built on debt, cheap credit, and the illusion that prices could rise forever. That illusion is dying. And as it fades, the middle class, the group that depended on it the most, is being left behind. Not suddenly, but slowly. Not through a dramatic crash, but through a quiet erosion of solvency, affordability, and financial stability. The greatest housing crash of our lifetime isn't coming. It has already begun, and it will define the next decade.